Hello, this video is brought to you by Moloney Street Re, your trusted investment research partner. Our mission is to guide you through the complex world of investing to grow your wealth, providing you with simple and basic knowledge, insights, and strategies you need to make smart investment choices. Don't forget to hit that subscribe button, like our videos, and share them with your friends and colleagues. Together, we'll navigate the path to success and make the most of your investment opportunities. Investing successfully requires more than just picking the right stocks or bonds. It also involves understanding the broader economic environment and market trends that can impact the performance of various assets. By interpreting economic data and staying informed about market trends, investors can make more informed decisions and optimize their investment strategies. This article explores how to interpret key economic data, understand market trends, and use this information to make better investment choices, with practical examples to illustrate these techniques. Understanding economic data is a powerful tool for investors, providing insights into the health and direction of an economy. Key economic indicators can help investors assess the business cycle, predict future economic conditions, and identify investment opportunities. Here are some of the most important types of economic data to monitor. The Gross Domestic Product, or GDP, measures the total value of all goods and services produced within a country over a specific period. It is a primary indicator of economic health and growth. How to use it? A growing GDP indicates a strong economy, which can lead to higher corporate earnings and increased consumer spending, benefiting stocks and other investments. Conversely, a shrinking GDP may signal a recession, leading to lower corporate profits and potentially declining stock prices. In the wake of COVID-19 pandemic, for example, many countries experienced a sharp decline in GDP, signaling economic contraction. Investors who anticipated this downturn may have shifted their portfolios towards more defensive sectors such as utilities and consumer staples, or assets like government bonds to mitigate risks. Inflation rate, on the other, measures the rate at which the general level of prices for goods and services is rising, eroding purchasing power. Common measures of inflation include the Consumer Price Index, or CPI, and the Producer Price Index, or PPI. How to use it? Moderate inflation is a sign of a growing economy, but high inflation can erode returns on investments, particularly fixed income securities. Conversely, deflation, a decrease in prices, can lead to reduced consumer spending and economic stagnation. In an environment of rising inflation, such as the one experienced globally in 2021 to 2022, investors might consider investing in assets that traditionally perform well during inflationary periods, such as real estate, commodities like gold, and inflation-protected securities, for example, Treasury inflation-protected securities, or TIPS. The unemployment rate measures the percentage of the labor force that is unemployed and actively seeking employment. It is a key indicator of economic health. A low unemployment rate indicates a healthy labor market and can signal economic expansion, which is typically positive for stocks. High unemployment can indicate economic weakness and reduced consumer spending, which can negatively impact corporate profits and stock prices. In the United States, during the 2008 financial crisis, unemployment rates soared, signaling economic distress. Investors who observed this trend might have moved away from consumer discretionary stocks, which rely on consumer spending, towards more stable investments such as bonds or consumer staples. Interest rates set by central banks influence the cost of borrowing and the return on savings. They are a critical component of monetary policy. Rising interest rates can make borrowing more expensive, slowing economic growth and potentially leading to lower stock prices. Conversely, falling interest rates can stimulate economic activity by making borrowing cheaper, often boosting stock prices and encouraging investment in growth sectors. In 2020, central banks around the world cut interest rates to stimulate economies affected by the COVID-19 pandemic. This led to a surge in stock prices, particularly in technology companies that benefit from low borrowing costs. Investors who anticipated rate cuts were able to capitalize on the subsequent market rally. In addition to economic data, understanding market trends is crucial for making informed investment decisions. Market trends can be identified through technical analysis, market sentiment, and other indicators. Here are some key techniques for understanding market trends. Delving deeper, let's look at technical analysis, which is the process of analyzing historical price movements and trading volumes to predict future price movements. It uses tools such as charts, patterns, and technical indicators like moving averages and the relative strength index to identify trends. How to use it? By identifying trends and potential reversal points, investors can make more informed decisions about when to enter or exit a position. Technical analysis is particularly useful for short-term trading and timing market entries. For example, if a stock consistently forms a head and shoulders pattern on its price chart, it may indicate a potential reversal from a bullish to a bearish trend. Investors can use this information to sell the stock before the price decline accelerates. Market sentiment refers to the overall attitude of investors towards a particular market or asset. It can be bullish, meaning positive, or bearish, meaning negative, and is often driven by news, events, and investor psychology. Understanding market sentiment can help investors gauge whether a market or asset is overbought, which indicates high sentiment, or oversold, which indicates low sentiment. Contrarian investors often use sentiment analysis to identify buying opportunities when others are fearful and selling opportunities when others are overly optimistic. For instance, during times of panic selling, such as the early days of the COVID-19 pandemic in March of 2020, market sentiment was overwhelmingly negative. Contrarian investors who recognized this sentiment as an overreaction were able to buy quality stocks at discounted prices, benefiting from the subsequent recovery. Sector rotation involves shifting investments between different sectors of the economy based on their performance and the stage of the economic cycle. Different sectors tend to perform better during different phases of the economic cycle, such as expansion, peak, recession, and recovery. By understanding the economic cycle and identifying which sectors are likely to outperform, investors can adjust their portfolios to take advantage of these trends. For example, cyclical sectors like consumer, discretionary, and industrials often perform well during economic expansion, while defensive sectors like healthcare and utilities perform better during downturns. In a recovering economy, investors might rotate into technology and consumer discretionary stocks, anticipating increased consumer spending and innovation. Conversely, in an economic downturn, they might shift to healthcare and utilities, which provide essential services regardless of economic conditions. By combining insights from economic data and market trends, investors can make more informed and strategic investment decisions. Here are some practical steps to apply these techniques. Stay informed. Regularly monitor economic indicators, market news, and trends. Staying informed allows you to anticipate changes in the economic environment and adjust your investment strategy accordingly. Diversify. Use economic and market insights to diversify your portfolio across different asset classes, sectors, and geographic regions. Diversification can help mitigate risks and take advantage of opportunities in different parts of the market. Use a top-down approach. Start by analyzing the broader economic environment, then focus on specific sectors and industries that are likely to perform well. Finally, select individual stocks or assets within those sectors based on their fundamentals and technical indicators. Manage risk. Use stop-loss orders, position sizing, and other risk management techniques to protect your investments. Understanding economic and market trends can help you identify potential risks and take proactive measures to manage them. Think long-term. While economic data and market trends can provide valuable short-term insights, remember to maintain a long-term perspective. Successful investing often requires patience and the ability to stay committed to your strategy, even during periods of market volatility. Interpreting economic data and understanding market trends are essential skills for making better investment choices. By analyzing key economic indicators like GDP, inflation, unemployment, and interest rates, and by staying attuned to market trends through technical analysis and market sentiment, investors can make informed decisions that align with their financial goals. Whether you're a seasoned investor or just starting, mastering these techniques can help you navigate the complex world of investing and build a successful portfolio over time. Thank you for staying thus far watching. In rounding up on yet another of our insightful videos, remember investing offers numerous opportunities for wealth creation and portfolio growth, yet it requires a foundation of knowledge, thorough research, and strategic planning. You need to understand the basics of investing, conducting diligent and employing diversification strategies so you build a resilient investment portfolio for the long term. Encourage us by subscribing to Maloney Street, YouTube, Instagram, Facebook, X, and TikTok channels to stay up to date with our valuable contents.